Any change in the thesis around stag deflation, that term that's used?
No, we're going to declare victory so everybody can send their checks into us for having that call exactly correct. Maybe we'll get like 1 or 2 months with a 0.1, 0.2 uptick, but then the next month is going to go away. This is what the Fed is being so stupid about. It's a one-time increase. So with a lot of it's going to be arbed away, so I'm not even sure we'll ever see it. By the way, oil's offsetting more than the tariffs. So we've been 100% correct about stag deflation.
So many big things and good things are happening in the lead line media world, as well as in the infrastructure capital world. We're going to be talking about markets, tariffs, second half of the year, where we've been, where we're going, and all kinds of fun things with Mr. Jay Hatfield. For those that are watching this across X, Instagram, LinkedIn, YouTube, I can see your comments. I can see your posts, which means do me a favor if you want to engage during this roughly 45, 50-minute conversation. Don't hesitate to post whatever platform you're on. I'll bring it up, make this as interactive as possible. As always, this will be an edited podcast under Lead Lag Live on Spotify, Apple, and YouTube. Continued momentum there. And spoiler alert, there's going to be a new host soon to come at the end of July, who I am very excited to bring on. She's going to be a phenomenal resource for the company. So hopefully she's hearing that as I'm saying that. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me here is Mr. Jay Hatfield of Infrastructure Capital. I want to call you a macro guru. Is that a fair thing to say, Jay? I don't know.
Well, I would say yes, because again, I've given up being humble. And we have been far more accurate than any Wall Street firm in our targets. In fact, I think it was super embarrassing for them because most of the firms, or at least a good portion of them, when the market was at 5,000, they all lowered their targets, and today they all raised them back. Whereas we did kind of pull ours for a couple of weeks, but we were consistent at 6,600, corrected for corporate taxes. And that's important because if people are just like, oh, the market's way down, it's terrible, and oh, it's way up, it's great, it's extremely unhelpful.
By the way, I'll use a term from the CFA Level 4 exam. That's not bullshit talk from Jay. And I say that because I've been interviewing Jay for the last several months, and it's true. Even in the midst of the terror tantrum, folks, Jay was, steadfast in his views on things and didn't change his outlook and has clearly been much more right than wrong. Let's do a recap of the first half of the year, because I think there was a lot of noise, not that much signal, a lot of fear, a lot of short attention spans. Which I think is sort of the real interesting thing about the last 6 months. But what's your recap of what we went through? I mean, did it play out the way that you thought it would? I mean, from my perspective, hearing you, it clearly did.
It did. I liked your term, which I hadn't used before I heard it from you, of tariffs being a nothing burger.
I thought you were going to say the bullshit term is.
But the reason I say that is that I would argue, unfortunately, I have to watch financial TV all day long, that most economic analysis is really just hidden political analysis. And really, the majority investors are not core Republicans and don't like Trump. And I'd say 90% of economists do not. They're Keynesians and trained in liberal universities. And so we think that there was way too much bias towards these tariffs being some horrible thing. And by the way, they are horrible for Europe and Japan and exporters, but we are really essentially a closed economy. About 10% imports. Of those, about 30 comes from Mexico and Canada, which are mostly exempt from tariffs because of the treaty, USMCA. So we're really dealing with 7%. It's not fully passed through to consumers. So that's like and by the way, it's also, that's about what potentially tariffed imports are if CPI is less than 10. So you're really talking about a maximum impact on CPI, which we've seen 0 so far, of about 0.3, which is not material. And even though particularly the Democrats on the Federal Reserve Board don't acknowledge this, that's a one-time hit that should be ignored for the purposes of making monetary policy. So everyone treated the tariffs as this is the end of the world. And also they ignore the revenue, which is very positive for the deficit and positive for rates. So we think the analysis was horrifically bad. That's starting to become obvious now as you see these CPI reports. There was 30 billion of revenue last month. I'm not sure if that's sustainable, but some significant amount of revenue coming in. We think the budget deficit is going down next year, notwithstanding all the political talking points about the OBBBA. So we are constructive. The only caveat I put out there is that targets are not just a way to promote stocks. They're also a cap. So we have a 6,600 target on the S&P. And literally on Thursday, it sounds kind of stupid, but it's like I was looking at my screen. I said, holy moly, we're at 6,300. And, keep in mind that's the year-end target is 22 times next year's earnings of around roughly 300. So like if we're in early July and we're at 6,300, like that's not that bullish really, because you're going to have the sell-off probably August, September. So we're going to be surprised if we maybe rally a little bit in July. The earnings will be positive, but the target is now like it was super bullish when we were at 5,000. Now it's not that bullish. We do think we'll exceed it, but not right away. So we're slightly positive on stock prices, but would be more positive if we were starting from a lower base. In other words, we basically got this July rally in June.
Now, the key thing there is that we're talking about the S&P when you're talking about that. I myself very much think we could have sort of a digestion period for large caps. Mm-hmm. And small caps could be where all the action is. I mean, because small caps are still very far away from their highs, pre-tariff, while the S&P has overtaken it. So let's talk about that because you got a small cap ETF. Tariffs clearly hurt small caps more disproportionately. Tariff threats are still out there. First of all, why is it that small caps haven't kept pace in the rebound?
I don't think it's really like if you analyze small caps, I don't disagree that there's a notion that they're more tariff focused or exposed. But when you really look at them, they're not really, because we do the value part of small caps. So you get a lot of domestic financials, utilities, REITs, and the manufacturers do actually tend to have overseas production that gets sold into their local market. Don't really import a lot of their materials. So we think that's a bit of a misnomer. But to your point, if tariffs are terrible and everybody's freaking, small caps will go out down the most, mostly because they're just de facto high beta or high market risk stocks. Where they're really going to shine, and they were recently, although rates have been moving up in the last 3 or 4 days or week or so, but they do really well when rates drop. So if there are Fed rate cuts, which we're projecting, then small caps should do well. And also, just if the market's strong, they don't actually have measurable beta, or in other words, higher risk, but they are higher risk asset class. So in a power rally, they will outperform.
I'd love to see that personally, because that's an area that nobody is really in. And you can argue for good reason because it hasn't worked, but it's like cycles are still a thing. And
the nice thing about our fund is that it's value oriented, as I mentioned. So you're not taking a risk on biotech that are companies that are losing money. So that kind of stacks the odds against you. And we have it structured to produce substantial income, partly from preferreds. So even if you're wrong, you're kind of right because you're getting paid to wait. So we think you're already taking enough risks in small caps. So why not be in the higher quality ones that pay dividends? They're not only producing earnings, but trading at reasonable PEG ratios or really PEG-Y ratios. So we do like the asset class. It's been thankless, but at least in our fund, you get paid while you wait.
Okay, so we touched on small caps. Let's talk about the next 6 months of the year. Small caps are obviously a part of that. There's still concerns around tariffs. I mean, they didn't matter before. They were a nothing burger before. I'm curious, is there any scenario where suddenly they could actually like legitimately matter, that it's not noise?
Well, this sounds a little bit ridiculous, but it's nevertheless potentially insightful. Sometimes the things that sound the most ridiculous are the most insightful. But I would just caution people to keep the seasonality more in mind. So obviously there was a huge tariff tantrum on Liberation Day, but keep in mind that was also at a time when earnings season had ended. So there's really no information flow. And so there was just stuck into a vacuum. So I think that a lot of as is happening today, there's a lot of tariff noise out there. Market's reasonably strong, at least on a broad basis. And so I would be worried about all the tariff news in August and September, which are usually terrible months. It's kind of hard to trade because July is usually great. And then August and September are usually terrible. So that's the only thing to be aware of, that probably people won't care that much because earnings are coming out about tariffs. But then that may be the only thing to stress out about. So it'll be a good excuse to sell out, market off. And as I mentioned, the market's pretty well bought here. So kind of ripe for a sell-off, as we saw yesterday on some tariff news. So but I think we'll be fine in July. Small caps will work, but then they'll come off. So there might be one more buying opportunity before we get a normal year-end rally.
Okay, so we got that side of the world covered. Let's talk about rates, because I think you're still expecting rates to fall. And it seems like the betting markets are changing. And when you have the Fed futures, as far as probabilities now being less, I myself keep on saying that I think the next move may actually be a Fed hike. And maybe that's some engagement forming, but I have some reasons for that. But I'm curious to hear your thoughts on sort of the state of monetary policy here.
Well, you have to, of course, start with inflation. And we're super bullish about inflation. We, unlike almost everyone else, and no one in the Fed, as far as I know, focus on the money supply. Excessive monetary growth causes almost all inflation, except for excessive increases in oil prices, which happened in the 70s. They're down now. Money supply shrunk 8% year over year, which is very scary. That usually produces a recession. Housing market slowing. Real-time inflation. So in other words, marking shelter to market. So if shelter's 2 years delayed, that's arguably why the president calls Powell too late Powell. But to be fair, it's not just the Fed chair. The whole Federal Reserve is too late. And that's because they use the reported numbers, which are wrong. We have it on our website. CPI year over year core 1.2%. PCE 2% year over year. The difference is that shelter's much lower in PCE. So we're really headed to deflation. And the Fed may continue to ignore that, particularly the Democrats in the Fed. This notion that they're not political is not true. There's 5 Democrats or 4 Democrats, Powell's neutral, and 2 Republicans. Republicans want to cut. The Democrats think that, tariffs are horrible. Trump's horrible. Well, we don't know that, but potentially. And they believe in the expectations theory of inflation, which we think is ridiculous in the U.S. at least. So we think that, but what's going to get their attention is the labor market's clearly weakening. Nobody seems to care. Only 74,000 private jobs created last employment report. Rising unemployment, continuing claims. So that'll get the Fed's attention. So we're still highly confident in at least 2 cuts, if not 3 this year, and rates going below 4% this year, because we're not going to see long-term impacts from the tariffs, monetary policy, ultra tight, oil prices down, offsetting any possible increase in tariffs. So we're super bullish about inflation, bearish about the labor market, which adds up to almost certain rate cuts.
Let's talk about oil. Everyone's freaked out for a little bit of time there around Israel, Iran, and there was an oil spike. And again, I go back to what I alluded to earlier. Everyone's attention span is really short. I'm not sure kind of where things are right now, even as far as that goes. But are you surprised that oil didn't really sort of have a more lasting
Not really. So we did put out a note over some weekend the weekend where we bombed the Iran. And what we said was, yes, of course, it's going to have a knee jerk up, but there was no oil facilities destroyed. And so the fundamental supply demand picture is slightly negative because OPEC, partly because of Trump administration's overtures, is increasing production. And that's keeping a lid on prices. So this is a wide range, but oil trades on wide range. So we have a $60 to $80 range or 70 mid price. And so we're more neutral here. The 70 is working really, really well because if you saw there was a surprise increase in OPEC production, but because we were at 67, oil didn't even go down. So we're just neutral on it, but that's still positive for inflation. And we were correct because in that note we put out, we said there would be a knee jerk, but then we're going to, fundamentals will kick back in and we'll probably go back to 70 or below. So that's exactly what occurred. So we weren't surprised by that. What you really need, or not need, but if it does occur, if there's major destruction of Iranian production, then oil will go up. Roughly, there's 3 million barrels produced, roughly $5 a barrel. So you could get $15 higher. But of course, the Saudis, who are aligned with the Americans, who are aligned with Israel, do not want the oil fields destroyed. So that's what's happened so far. Not very surprising. And that's kept oil prices down, which is a Trump administration policy, as it was sort of for Biden, at least later when it became a political problem that oil prices were going higher. So we don't anticipate destruction of oil facilities, but that's what it takes to have a sustainable increase in oil, because there's a rough balance around 100 million barrels a day of production and consumption. And it is sensitive to price. So if it runs 75, there'll be less consumption, more production. Everybody forgets the elasticity or the sensitivity to price of oil. And so they tend to get too concerned about it skyrocketing. And then if it's down, they project it's going to zero. And neither of those situations are really very likely.
And oil is very obviously correlated to inflation expectations. So you're only going to really have inflation expectations sustainably go up if oil sustainably goes up.
Correct. And also, we just believe that this is sort of the fatal flaw of the Fed, that they implicitly assume that expectations can produce inflation. But for that to occur, you need to have market power. Like if, it's one thing for a union to say, oh, inflation is going up, so we're going to bargain for higher wages, but try calling up your employer and telling him that your inflation expectations are rising and they need to pay you more. It's just not going to happen. So, and also companies don't have significant market power in the U.S. to raise prices. So we completely reject the using expectations as an exogenous variable. So in other words, in a variable like money supply or oil prices that drive inflation, they're just a result, as you were implying, of just really not very focused individuals who go to the pump and say, oh, inflation is bad because oil prices is up, or it's good because they're down. Or more likely, like the Michigan survey, Democrats think inflation is going to 10 and Republicans think it's going to 1. So you're just really polling people's political alignment, and they're obviously not great economists. So we think that expectations should be eliminated from monetary policy and also from, investors' concerns, because it's a dependent variable or endogenous variable.
Let's talk about the financial sector a bit here, because I myself am very much of the mindset that we are going to see a lot of deregulation coming in the next several months. Executive orders. Trump's already been doing these on Fridays, as we've been seeing. And I think even both Powell and Bessent have referred to the fact that regulations have really hurt, especially the regional banks. Let's talk about how the financial sector shapes up here, and then some of your funds that might be ways of playing that.
Right. So we've been bullish on financials correctly for about a year. And there's really 3 tailwinds. You mentioned one of them is deregulation. That's great, but we don't really depend on the government, don't like to depend on the government, but there's clearly been deregulation, lower capital requirements, stress tests produce higher dividends and buybacks. But the key drivers, and so we think regional banks will do fine, particularly if there's Fed rate cuts, as we are projecting. But the big investment banks we think will do well, the private equity firms, because we do anticipate a continued AI boom. You're seeing that in companies like Palantir, which are really overvalued in our models. If that continues, there's going to be an IPO boom. And then the other thing that people don't fully appreciate, I used to be an investment banker, so I know doing M&A deals is easier said than done. So the Biden administration gets voted out, then you start working on your deal. Well, that doesn't mean you announce it the next day. You announce it, you start pitching deals, and then they get further along, and then you start negotiating deals, and then you write up the transactions. So these things take 9 months to a year. So we think the backlog in M&A is building, but you're going to see the biggest boom in IPOs. That's going to be good for the private equity firms. So we're more focused on the high beta. So these are high risk. So the market's way off, like Goldman, Morgan Stanley, KKR will not do well, but we are still bullish on the market. So those are big positions in ICAP, our large cap dividend fund. And it's perfectly reasonable to say, well, okay, I'll just buy them myself because I could see your holdings. But we do write very short-term covered calls on that to optimize those returns and increase the yield, and you get better yields than you can by holding those stocks. So ICAP is well positioned, we think, in this market and will do well, and does have that financial bet on. We have regional banks too, but particularly these high beta private equity firms and investment banks.
Let's talk about preferreds here for a bit, because I think preferreds are always an interesting part of the marketplace that don't tend to get a lot of attention. You've got a fund that focuses on that, but let's do a little education on preferreds and maybe how strength in financials could benefit preferreds.
Right. So the key thing with financial preferreds is it is fixed income. So I was having a call before this call with an advisor, and he was talking about a REIT fund, and I said, well, I wouldn't sell if you're bullish about REITs, I wouldn't sell your REITs and buy preferreds because they're fixed income. So they're going to do well, but probably not as well as equities in the long run. But the great thing about preferreds, they have substantial yields, like PFFA yields over 9. Another fund, PFFR, yields right around 8. So if you just get your coupon, those are pretty good returns, pretty close to equity returns. But the way to think about preferreds is fixed income, but higher risk fixed income. So not like a BND, which is a ag fund or an investment grade bond fund, but more like high yield. So you get higher yields. You have about 50% correlation to the stock market, 30% to bonds. So if we're right that we have higher stock prices, lower bond yields, then preferred should do really well. So you won't just get your coupon. You get your coupon plus capital appreciation could be up to 10% over the next year, not necessarily by year end, but over the next year when we get these Fed rate cuts. So we think well positioned. You might get kind of equity-like returns until rates go to normal. Another way to gauge normal rates is you take the expected inflation rate, which is low 2s, add 75 basis points, which is a normal spread for Fed funds. So you get 275 to 3. And then normally the 10 years, 100 over that. So that's where we get to 375. You could argue 350. So that will produce 2 tailwinds, higher stock prices, lower bond yields for fixed income, but particularly preferreds. So they should do well in that scenario, but not necessarily keep up with your equity funds.
Yeah, I think that's an interesting component of it. Of all the various funds you've got now, where's the interest been strongest? What's sort of the vibe by advisors?
Well, it's just that, PFFA is a 5 Morningstar fund, 1.6 billion, has beaten all fixed income ETFs, including high yield ETFs and preferreds, and as like probably the best yield of an ETF, at least, probably of almost any even closed-end funds. So that we would have to try to not get inflows in that fund. We have had good interest in BNDS. High yield bonds are more like about 30% correlated with stock market and 10 to 20% on fixed income. So really low volatility. We have that good interest there. For more conservative investors, preferreds can get dislocated and the betas rise or the risk rises if people are freaking like during the tariff tantrum. Or high yield bonds are more institutional, tend to be more stable. So it's a good alternative if you want better safety, lower volatility to be in BNDS than the preferreds. So we've gotten good interest, just that fund isn't as big, so it's not as liquid and the inflows aren't as big.
What makes you nervous about the next 6 months? Let's talk about some of the risks that maybe could suddenly pop up.
I just think it's 99.9% is around the Fed, and do they just become dug in? Like it's really not good strategy to publicly criticize the Fed. What you should be doing is privately lobbying them. That's a mistake the Trump administration is making. So maybe they just dig in their heels and it just becomes a big political battle between the Democrats and the Republicans. You don't get these cuts. You get a recession starting in the housing sector, declining employment, and, some negative reaction in the stock market. So just a completely out to lunch Fed, which is not impossible. They've been completely out to lunch in 21 as well.
I know you like to sell options. I know you're a fan. I think we should introduce that idea to the audience for those who have not heard you before. Talk about that in the context of various funds. What are the benefits? How does that impact yield across the different ETFs?
Right. Well, so we have a unique approach to it, and particularly for ICAP and AMZA. It's called Theta. It's decay. We want a lot of decay because that's where the income comes from. So it takes a lot of work, but we get economies of scale because we're running a big fund. We rate 1, 2, 3 week options. And what's good about, there's two good things about you get expirations every week and you can manage your exposure to the market. If you rate longer term calls and the market starts running, you lose your upside. Like if you look at the biggest fund out there, call writing fund, JEPI, you'll see that when a market runs hard, it underperforms by a lot. So, but we have better flexibility because the options are short term. Things get called away. We can replace it with other stocks. So we're very short term. It works. We do it on individual stocks by cap at prices where we have gains, where we think the stock's fully valued as well. So we use HI or human intelligence to do that, not mechanically. And we do that a little bit with AMZA, less than ICAP because it's all one sector, which is energy related. So all the stocks are either up or down. We're in ICAP, whereas in ICAP, the stocks that are up might get called away, but maybe they were expensive. We recycle into another sector. And with SCAP, we do something different. We think we do it better than the JEPIs of the world. We rate weekly calls, but out a little bit farther, 6 weeks out, where there are weeklies, and only on the index. Because what we don't want to do, small caps are kind of the opposite of large caps. Like ExxonMobil and Chevron are probably not going to get taken out, but any small cap can get taken out at any time. And also if they beat earnings, they'll be up like 30% because they're not well covered by the street. So you really don't want to cap your ups, and they only have monthly options, not weekly. So that's why we just do it on the index. We do it out 6 weeks, up a lot. So it's kind of a high class problem if it gets called away. And we do manage the exposure to the market so we can buy underliers to offset the calls. And we use judgment. We're not writing a lot of calls in July because usually a pretty good month. So we have kind of 3 different strategies that do call writing, which are appropriate to the asset class. You don't want to just mechanically write calls.
So that's interesting. Actually, I actually didn't realize that when you do factor in seasonality.
Yeah, absolutely. You have to have a view on the market. What's good about our strategy is that, again, at least on the individual calls and also on the index calls, because we're not stupid, is that, we're only write them at a gain. We're not going to be like, Goldman Sachs is down at 600 and we bought it at 650. Let's write a ton of calls at 630. So we naturally, like when the market at 5,000, we weren't writing any calls because, we wrote some because you could write them on McDonald's, and defensive, we're doing well. So you kind of automatically take the advantage of the securities you're doing well in your portfolio. So it kind of also automatically precludes you from doing something stupid. But if you're just mechanically doing it, then you just write the same amount of calls when the market's at 5,000 than when it's at 6,300. So we use judgment both on seasonality and valuation of the market, but more importantly for ICAP, valuation of the individual stocks and where we have a gain. It's really dumb to lock in losses by writing calls.
The seasonality part is interesting, and the judgment part, obviously, the big part of that, which I'm a huge fan of. What have we not talked about that you think is important? I'm with you. I have CNBC and all the mainstream media on mute, like everybody pretty much does in our industry. Just kind of see what the mood is. But we know that mainstream media doesn't really cover the stuff that matters most.
Well, I think we've covered it, but I would just emphasize it because it seems like no matter how many times I say this on television, everybody kind of ignores this. Is the seasonality is critical because it colors people's analysis of what's going on. So if Broadcom blows out earnings during earnings season, then all the tech stocks are going to rip. So it kind of doesn't matter if Moody's downgrades the US or there's a tariff tweet that people are concerned about. And we just generically think people are way too concerned about tariffs. Like I would be worried about tariffs if I lived in Europe or if I lived in Vietnam, but we don't. And so for the US, the Trump administration is correct. They have tremendous bargaining power. We sort of don't care. And by the way, if Vietnam has a 20% rate and South Korea has a 40, then we're going to get all of our imports from Vietnam. It doesn't hurt us. It hurts South Korea. So I think that's completely misanalyzed. But if it comes out during the wrong seasonal time, the market can get smacked by it. But you saw, market got hit a little bit by the tariff chatter on Monday. That's partly because we just had this enormous run. You also have to look at valuation. And clearly, 22 times is our target. Well, you kind of need lower rates to justify that. So the market is pretty fully valued. So maybe it does get hit by some of this tariff news, but we got the earnings coming up to offset that. But once we get through earnings season, it wouldn't be the worst idea to raise some cash and maybe put it to work a little bit later or buy fixed income, just clip your coupons and not necessarily be in the high beta stocks. So I would overlay good fundamental analysis with the seasonality and recognize that the market becomes inefficient when there's no earnings coming out.
Any change in the thesis around stag deflation, that term that's used?
No, we're going to declare victory so everybody can send their checks into us for having that call exactly correct. It may be we'll get 1 or 2 months with a 0.1, 0.2 uptick, but then the next month is going to go away. This is what the Fed is being so stupid about. It's a one-time increase. So with a lot of it's going to be arbed away, so I'm not even sure we'll ever see it. By the way, oil's offsetting more than the tariffs. So we've been 100% correct about stag deflation. I mean, there's always a measurement issue, but critically, shelter has now come down. It's very lagged, so it should not go back up because it's just slowly reflecting the fact that market rents have come down. So shelter is a big tailwind. The year over year shelter's 4, but it's really running at more like 2% now. So just every month, the shelter will come down on year over year basis. So we still think we're in stag deflation. We're risking a recession. We're risking deflation. The Fed's inflation models are broken. They focus on the Phillips curve or employment, should focus on the money supply and oil prices. So we're both declaring victory, but think it will continue. And by the way, we changed our mind. When oil was at $75, we revised our notes. But then when it came crashing back down, we were like, okay, well, now the tailwinds are still for stag deflation.
For those who want to learn more about the various funds, infrastructure capital, talk about where they can go. And then let's talk just maybe towards the end here around BNDS more specifically.
Right. So www.infracapfunds.com. And I will recommend signing up for either a monthly webinar or both, really. and our emails, because you can go look back over the last 4 years and they really have been kind of ridiculously correct. And even if you don't agree with us, we give you really good proprietary fundamental data so you can come up with your own opinions that you won't hear anywhere else. Because I haven't heard this negative 8% money supply growth from anywhere other than ourselves, and it's very profound. So you could ignore that, but at least you have that data. And then with regard to BNDS, like I said before, you get an 8% yield, low volatility, low interest rate sensitivity, low stock market sensitivity. I've been adding it in my IRA because, I'll try to be conservative, one income. And so a good alternative to preferreds, it's lower return, lower income, but lower risk, but not terrible income. 8's pretty good. I know our preferred funds over 9, but less volatility. So without risk, no return, lower risk, lower return, but not that much lower. So BNDS, good alternative for conservative investors who want substantial income.
Hopefully we will see you all in the next episode of Lead Lag Live. And special thanks to Jay Hatfield. Thank you, everybody, for watching. Thank you, Jay.
Thanks, Michael. It was great.
Cheers, everybody.